and I'm the founder of M2HR, an executive search firm focused on industrial middle market. And I'm also the immediate past president of ACG DFW, and I've been honored to serve in that capacity. We're thrilled to welcome you all here today to another great Dealmaker panel. It's been quite a crazy year, and the deal making community has seen a big swing in business. Today, we'll be looking at capital movement forecasting, deal flow expectations, and what you should be on the lookout for in the coming months and quarters and year. We have a few housekeeping items to go over before we begin. You've all been muted and your video has been switched off for the moment. Our ACG staff will be turning video back on, and you will be able to unmute once we move into the networking portion. If you have questions for the panel, and I know you will, I hope you will. The panelists love questions. Please use the chat box, and that should really only be used for panel questions. If you have any other questions or technical issues, please send a private message to Brittany or Christy, and they'll get it taken care of with ACG DFW. I'd like to take a moment to thank our programs committee who put this panel together. Our DFW chapter is lucky to have a very vibrant and dedicated group of individuals who want to bring value to everyone who attends any of our events. And I'd like to thank you for all that you do. Jill, you're at the top of my mind. We've got new members, and our biggest value is what we try to provide to our members, and they are really the reason we're here. So I'm thrilled to welcome our new members: Bill King with Four Kings Capital. I'm not sure if I see him on the screen. Chris Goodwin, Star Mountain Capital. John Gosser with Griffin Financial Group. Tin Lee with Carr, Riggs and Ingram, and Xavier Egan with Capital Asset Advisors. So welcome all of you to ACG DFW. And you heard the golf clap from me. We could not bring these events to you without the unending, outstanding support of our content program sponsors. So our annual growth sponsors for the 2021 ACG DFW year, our platinum sponsor is Calvetti Ferguson. So big thanks there. And big thanks also to our gold sponsors, BDO and Perkins Coie. So thank you for all the continued support of ACG DFW. I know we're ready to get started, but just so you know how the morning will go in terms of timing and flow, we will begin with the panel discussion. We'll move into questions in the chat box, and we'll finish with some structured small group networking. So for now, sit back, relax, and you will be requested to turn your video back on once you enter the networking small group rooms. And that's it. Now, we can get on with the program. and I am happy to introduce today's moderator, Jill Lewis, who is an attorney and partner with Perkins Coie. Jill has a vast knowledge of the middle market across virtually all industries and has worked through some amazing deals throughout her career. Jill, thank you for moderating today, and I will turn it over to you.
You don't have control of muting and unmuting, so they finally let me talk. I bet my family wishes they had a similar button that would just like shut it down. So anyway, I'm really excited for you all to get to hear from this panel. It's a group of people that I have known for quite some time and have really appreciated their viewpoint over time and their vantage point in the marketplace. So I want to tell you a little bit about them. Typically, I do not do, big intros and bios and like to get down to the meat of it, but I think it sets some nice context for you to know a little bit about these folks. So first up is Clark Greiner, and he is the CEO of Revere Capital. He's the founder and principal. He has had over 20 years of experience in real estate investment, private equity, and investment banking, including a tour at Deutsche, where he served on the private equity real estate team, as well as new business underwriting committee. Over his years in investment banking, he's participated in traditional market capitalization, real estate mergers and acquisitions, and workout and restructuring. He has significant institutional experience on both the principal investment and investment banking side. He has skin in the game. He understands how this business works. He has also served as owner, lender, operator, sponsor, and equity partner, and I really appreciate it today. Prior to his real estate career, he also served in several political positions at the state and federal level. So welcome to Clark. Next, and hopefully we've gotten him to rejoin. We had a little bit of technical difficulty. I'm going to go ahead and introduce Andrew, and hopefully we'll see him pop up here on the screen. So Andrew Wallace is General Counsel of the North Tarrant Express Concessions of the International Infrastructure Company, Sintra. And so any of you who run up and down LBJ or head over to Fort Worth, you are riding on their beautiful managed lanes, and the safety and security and the speed and congestion control is a fine-tuned machine that they have developed and really appreciate his help with the growth here in North Texas. And he represents the 3 concessions that have been developed for that purpose. He's a member of the leadership team for Sintra's North Texas concessions, and he manages all the legal affairs for the concessions, providing advice and counsel to them. He finished Georgetown undergrad as well as law, and also received his MBA from the University of Texas at Arlington. And last up, but certainly not least, we have Rodney Green. Rodney is a Wall Street quant with a physics PhD and 20 years of experience in quantitative model development at the Federal Reserve Bank of New York and global investment banks, including Goldman Sachs, Royal Bank of Canada, and Citi. His PhD in physics is from University of Illinois, Urbana-Champaign. He has an MS in electrical engineering at from UT Austin, and got his bachelor's in engineering science from Harvard. RG Risk Consulting is his firm, and he brings value to firms by providing subject matter expertise in model risk management, market risk model development, and systems implementation. RG Risk Consulting seeks to bring the stress testing and scenario design techniques of the largest banks to the middle market advisory. And very excited to have him here and to help us kind of think through what will 2021 hold. Well, I recall the last Dealmakers breakfast just before the veil of COVID fell. It was a wonderful winter day, bright, sunny, and we were at the Velo Mansion, and we could not have imagined that 2020 would unfold the way that it did. COVID-19 took a booming economy into recession with a strangely buoyant stock market. It's been reported that deals dropped by 29% in the second quarter and values fell by 70%. The comparison year to this is not 2008, but rather 2001's dot-com recession, but really greater. Partially, the difference in the experiences that we're having is the deferment of debt payment and rent for many companies, as well as unprecedented levels, and who's tired of that word, unprecedented, but unprecedented levels of government stimulus. So we are not experiencing the absence of liquidity that we did in previous crises. And I think that's going to matter as we discuss 2021. Deal volumes began to return in May and June as deal makers stabilized to the new normal. I saw that in my own practice, that people were not sure. Spent about a week with everybody drawing down on credit lines to their fullest, and then all of a sudden realize perhaps they're going to move forward with their deals. We can learn from recessions to make certain moves and be able to allocate capital in an advantageous way. COVID is pretty unique in that it has a bit of a reset value, things that we never thought that we would do, the remote work, the absence of going into the office, the ability to work across marketplaces in a lot of different ways has kind of changed the game on what we think we can accomplish. And COVID is also unique in that it is a full global and multi-sector impact. Stay-at-home orders and other COVID-related restrictions have risen the demand for technology as well as digital infrastructure. Tech firms have remained a top acquisition target, representing about 27% of transactions during the second quarter. Tech is outpacing consumer, real estate, media and telecom, as well as pharma and life science. Experts are anticipating that PE volume will be about 20 to 25% of the US deal volume for 2021. And deal watchers, top drivers for M&A in 2021 will be, of course, what are our U.S. economic conditions? Will this vaccine be able to be proliferated and administered widely enough for us to restart the economy? Will favorable interest rates persist and affect what we think they do in terms of structures? And will we continue to have a strong availability of capital? We're going to talk trends today, structure, and sectors. We have a severely impaired consumer base that may actually be a leading indicator to what will happen with 2021. While I've seen many reports that analysts are thinking that 2021 will result in an 8 to 22% growth in the S&P, largely driven on what happens with the stimulus that's currently being debated and what happens with the vaccine. But what I'd like to talk to is experts here who really have taken the time to drill into the data, not just what they feel, but what they are seeing in the data. So without further ado, I'd like to get our panelists into the game here, and welcome, Andrew. I'm glad you could get back in. We had such technical difficulties this morning, so I'm very pleased to see you, and great for the audience as well. So Rodney, let's talk a little bit about what can we expect for 2021. Are deal sizes going to be smaller, larger? Will people be willing to take on big bets and risks?
Thank you, Jill. To illustrate, I'd like to ask Brittany to put up the first slide, deal activity, please. Thank you very much, Brittany. So I'm going to go a little bit away from the question and say that based on what I see in this slide, deal volumes will continue to rise. So what we see here is two stock price indices for two large private equity stock price indices. So just like the S&P 500 is a weighted
is a volume weighted average of stock prices for 500 large companies. Both of these curves are volume weighted averages of large private equity firms like Blackstone and KKR. The orange curve is an index called GLPE. The vertical left axis is the value of that index, and the horizontal axis at the bottom shows that we're spanning about a year of data. So the orange plot shows GLPE took a big dive when COVID hit here in the United States and steadily rose since then. Similarly, the blue curve is the S&P listed private equity index. So just like the GLPE index, it took a dive in February and has been slowly rising since then. And so if we look at the far left-hand side of this plot, we see that both the orange curve and the blue curve are rising at a high rate. They've got a high slope as we move into January 2021. So my takeaway from these two plots is that deal volume will continue to increase as we enter into 2021. Now, as far as deal sizes go, I think generally speaking, deal sizes will diminish because there's ongoing uncertainty about the possible negative impacts on EBITDA from due to COVID. You know, deal makers are, because of this uncertainty, they're concerned about their projections on earnings potential for candidate targets. So they'll be more incentivized to take on smaller size deals to reduce their risks that are possibly coupled to COVID.
Thanks. So, Clark, I want to bring you into the conversation. You have an opportunity to see the deals that are coming into your shop, where people are looking for financing, what they're comfortable with. Do you see people looking for opportunities in particular sectors? And are the deals you're looking at now changed by COVID at all, such that 2021 is, business as usual or a real change?
Right. Thank you, Jill. Yes, my background or our firm focuses on the real asset, real estate, and especially finance side. So that's where I'm going to be answering that question from that perspective. If you bring up slide 1, which we sent in, you will see that we're having similar dynamics from what Rodney said. Deal volume is down year over year, about 50%. And this is private equity real estate. There's been about 2,000 transactions a quarter in 2019, 2018. In 2020, you're seeing that cut in half, Q2, Q3. Obviously, we are seeing the hospitality and retail space take a nosedive, both on valuation as well as deals getting done. But volume's down about 50%. Deal size is down about 35%. And what we're seeing, and why we think that it's going to be a slow out of the gates as far as deals going forward, is lenders are taking kind of the falling knife underwriting versus a more opportunistic underwriting. And I'm talking the bank world. They're looking at what could go wrong versus 2019 and before is what could go right. And so I think that will impair us out of the gate. I think either Rodney or Jill mentioned a lot of this will be predicated on, is there stimulus? How much is the stimulus and how is it distributed? We did see, and I think it was better articulated in Rodney's chart, when they pumped $2 or $3 trillion into the economy, high tide raises all boats. And we saw both in the real estate space as well as GLPE index, I believe is the name of it, volumes going up and valuations. So same thing on the real estate side.
Very interesting. So, Andrew, how do you see the impact of these trends in your unique vantage point at NTE?
Hi, Jill. Thank you. And I apologize for the technical difficulties I've had this morning. Well, we now know that essential workers include transportation workers. If we could go to slide 1, mobility and engagement index by state. Here, you see a massive drop in traffic in the first months of the pandemic, with steady increases through the remainder of 2020. And what you notice here is that at this moment, here in around November, mobility is currently down approximately 40% versus pre-COVID levels. But that Texas is actually slightly higher than the U.S. average to end the year. Slide 2, please. And this graph, I think, shows the impact of COVID on mobility by metropolitan area in Texas. Here, you see at the beginning that Houston and the Dallas-Fort Worth Metroplex suffered greatly and had a rough go at it. But here at the end of the year, you see DFW meeting the U.S. level, and notably Houston and San Antonio actually exceeding the U.S. level. But by way of comparison, you can also see that El Paso is impacted, largely consistent with the news that we've seen about how the crisis there is significant. So on the public side of transportation, sanitation and confidence really dominate the effectiveness of the public transportation systems, and the same really applies to air travel. I think a good deal of hope was placed on the impact of school openings, and unfortunately what we've seen are that patterns of movement of both people and goods have been substantially different this year, and frankly will take a significant amount of time to return to pre-COVID levels. As you would expect, though, as e-commerce accelerates, the importance of logistics and delivery networks has been substantial and quite important. And we have noted that those two sectors are actually more reliable than commuter traffic and contribute to the improvements in traffic density. If you could please go to slide 3, the map of the Texpress managed lane systems.
They're up.
Okay. Our projects have had a cumulative economic impact on the DFW region over the last 10 years at approximately $7.3 billion. And that includes the 35W project that we have in downtown Fort Worth that has only been open for 2 years. But it doesn't include the extension of that particular system north to the Alliance Airport. What you can see here is that private sector investment has created a managed lane system in the DFW Metroplex that basically has east-west travel interconnected. And what that does is it creates and enables DFW businesses and commuters to enjoy time saving. And I think that that's very unique to our region and has our region very well positioned for the rebound in 2021. But as far as trends, I think they can be summarized as follows: a reduction in demand, reduction in public funds, and new forms of mobility. We've seen, behavior translate into working from home and flexible hours, as well as retiming and respacing of actual trip patterns. e-commerce and the digitalization of offerings in the private sector have emerged. And I would say, Jill, that the twin crises of the pandemic and the global economy are global. And given that, you know, there is a vaccine now, we should be able to eliminate a prolonged global crisis. But how we emerge has a good deal to do with the consistency of the United States' ability to manage the healthcare system, combined with public-private partnerships, in my view.
Yeah, I think this is one of the times that we're seeing macroeconomic effects really impact us, you know, and the need to watch for those macroeconomic indicators to really, you know, get some sense of where we're going. So I have a question in our chat box. This one is for Rodney. With smaller deal size anticipated, or deal sizes anticipated, do you think that squeezes out a lot of independent sponsors?
I don't think it necessarily squeezes out independent sponsors. Yes, deal sizes are going to be smaller, and so as long as there are sponsors, whether they're independent or some sort of group, as long as they have the funding and they should be able to take advantage of the small deal sizes that I think will characterize the 2021 market. I think the groups that will be more successful will accomplish higher quality due diligence, and along the lines of what Jill just mentioned, seeing these macroeconomic effects impact EBITDA, those independent groups and investor groups who perhaps employ a market-based valuation where you're tying in these macroeconomic events into your valuations of a smaller company. Companies that do a better job of that will be the ones that are more successful. So the short answer is no, I don't think the smaller deal sizes will necessarily squeeze out smaller independent investors, but I think the thing that's going to distinguish the winners from the losers is their ability to do better due diligence that rolls in to their due diligence process these effects of macroeconomic stressed events like we're seeing today.
One believes strongly that audit, because we will have a lot of compliance issues around what happened with PPP loans. Are we ready for forgiveness? I know we're starting to build that into our due diligence, making sure that we're not acquiring companies that will fail to get the forgiveness. And so there are new aspects in which we are looking at these companies that are specifically, you know, COVID driven, because the way we have dumped capital into the marketplace, I believe that, you know, the tax man giveth and the tax man taketh away. Rodney, kind of as a follow-on to your point, what kinds of risks make sense now? We're doing more due diligence in your 2021, but what kinds of risks make sense? Because if everything was risk-free, there wouldn't be return. So what are you thinking about?
Thank you, Joe. And Brittany, if I could ask you to place up the slide that says bank lending. Thank you very much. So, you know, what does the word risk mean? Risk means an uncertain outcome. So an investor seeks to mitigate that risk doing different things. So in the world that I'm more familiar with, in the securities world, you can mitigate a risk in one position by taking another position that hedges the original position. So the two positions together form a portfolio with reduced risks, where the outcome of that portfolio is less uncertain. So hedging is a way to mitigate risk. Another way to mitigate risk is to get insurance. Another way to mitigate risk is timing your entry into the market. So there are lots of ways to mitigate risk. And you're right, you can't get rid of it 100%. You just need to understand it. You need to have a risk appetite statement or understanding in your head that specifies, enumerates the risks that are relevant for your deal and specifies sort of limits on those risk parameters. So one type of risk that I think makes sense to take on now is interest rate risk. So what we see in this plot, and so the bottom line is term lending from banks is approaching pre-COVID levels. So interest rates for lending activity is low. So what we see on this plot, this is taken from a company called SPP, which is active in the middle market deal financing space. So they're an investment bank that finances the middle market M&A activity. And so along the horizontal axis at the bottom, we see time. So this is showing typical bank lending rates over the last 5 years for middle market M&A activity. And so, you know, the gray line is the lower limit that this company saw for bank lending rates, and the blue curve is the upper limit for bank lending rates that this firm saw. And so, if we look at the arrows on the right, I'm pointing to the pre-COVID max and min bank lending rates. And so it looks like the minimum, so it was from roughly about 3% to about 4.5% pre-COVID lending rates. And then we see there's a bump around when COVID hit, looking at about from February to maybe May or June, there was a bump in lending rates. And now that we're on the far right hand of that curve, we see bank lending rates have more or less stabilized. So looking at those green arrows, looks like the range is something like 3.2, 3.5-ish to about 4.2-ish or so is the range for bank lending. And it seems to be stabilized. So timing your deals after that bump, and the bump corresponds with the onset of COVID and the slow trickling out of the stimulus, of the $2 trillion in stimulus. The interest rates have stabilized for lending. So entering into a deal that has interest rate risk in terms of your borrowing rate, it definitely makes sense to go in. That interest rate risk definitely makes sense to take on that interest rate risk. And it is kind of compelling that those rates are approaching pre-COVID levels and perhaps even lower than pre-COVID levels. So that's like that's just very surprising and a very compelling low risk onset of a low risk factor.
Yeah.
So
springboard, Rodney, to Clark and say, all right, so with low interest rates and availability of cash, do you see deal makers needing to look at other structures for their deals? Do you see that changing?
The big change that I see is, I think Rodney's right on the pricing, because LIBOR and Fed's rate have dropped so precipitously in the last 12, 18 months. What we're not discussing is the proceeds side. Our experience in the banking world is proceeds are coming down, but interest rates have stabilized. And back to that, they're underwriting for the falling knife situation. So I do believe, even though there's a lot of capital raised, especially towards the tail end of 19, beginning of 20, there's a lot of cash to be deployed, at least on our side, the private equity world. They have to deploy that in 2, sometimes up to 3 years. So they will need to get money deployed. I think they're going to see more distress opportunities, which will increase deal flow versus kind of the green shoots and stabilized deal flow we are seeing 17 through 19.
Thanks. So we've got some questions in here, and one is for Rodney with respect to piggybacking off the independent sponsor question, do you feel like smaller deal sizes will also shift the emphasis to smaller providers, perhaps?
I'm sorry, you broke up a little bit. Could you repeat that again, please, Joe?
The question was piggybacking off the smaller deal size notion. Do you think that that will also shift the opportunities and participants toward smaller providers of capital, smaller providers of sales targets, smaller providers of service industries, accounting firms, law firms, things like that?
Well, being a small firm myself, I certainly hope so. So let's fingers crossed that actually will come to pass. I think based on that first slide as well as comments from Clark and Andrew, deal volumes will continue to rise. There's a huge amount of undeployed capital out there, and so there's a lot of interest in pursuing all of these big deals. So investors need to have nimble advisors and nimble advisory firms and nimble financing to transact and close on these deals. So yes, I certainly hope there will be more activity from the smaller advisory firms and facilitators to affect these transactions. And I think that in the along the lines of what Clark mentioned on proceeds at banks have diminished because interest rates have declined. I think that means there's a lot of opportunity in the deal financing space as well. There's a lot of unallocated capital out there. So people are doing a lot more securitizations now. There's a securitization structure that's targeted toward M&A activity, these things called SPACs, special purpose acquisition companies. And so IPO volume in SPACs has roughly tripled in the past quarter. So so I think that deal makers will deploy their capital to smaller advisory firms because there's just so much business to be done, and deal financing will be more interesting and more creative, along the lines of securitizations.
Yeah, I want to collapse a couple of questions. We talked about the amount of capital in the marketplace, the low interest rates providing some opportunity, debt in your structuring. When we look at the question regarding, do we think self-driving technology is close enough to becoming a reality? And then we look at another question or really statement saying, given that we're in the midst of a pandemic that caused all of this, how are we looking at our healthcare system? Do we see perhaps opportunities to invest in things that add to our resilience, either in the mobility technologies that Andrew's company follows and thinks about, or in the healthcare arena? And I would throw that open to any members of the panel. Perhaps Andrew would like to comment, particularly even after the healthcare crisis has receded. How we live, work, and consume will have changed. But are there, investment opportunities that we think some of this that should be deployed toward? It's real,
Sure, Jill. Yeah, I think it's safe to say that after 2020, things can only go up. With the healthcare crisis, it has exposed some, fairly glaring and immediate concerns. And one of the deficiencies that you mentioned was the medical and healthcare infrastructure dilemma. Others, though, include maybe education, the digital divide, even the food infrastructure grid appears to be undeveloped and/or at least neglected. And so that's a lot to think about. And, from an infrastructural perspective, That's quite a bit to sort of reinvent. But in order to do that, I think it has to be done together with private companies for, at a minimum, funding and also the innovation required to sort of do it on any sort of transformative type of level. I think the issues, though, are going to be, who's leading this effort, and then, what are the priorities that are set. From an opportunities perspective, as Rodney and Clark have been discussing, our recent experience in the financial marketplace has been quite positive. That be even in the year of COVID. But I defer to and agree with my colleagues with respect to their opinions about the bullishness for infrastructure finance. Certainly from our vantage point, the deal sizes are fairly significant, but I think going forward, other than transformative type of projects, you're going to probably see projects much smaller and the need to finance them more creative.
Thanks. So we've got a question regarding, will strategics become even more active in the market in the coming months, competing with PE and independent and family offices? Do we see corporations, wanting to kind of activate their corporate venture capital? I definitely think that's, a lot of what I'm seeing in my practice is that, strategic bolt-on are in the marketplace and stayed fairly steady throughout, particularly depending on the sector they were in, stayed pretty steady kind of throughout the dips and whatnot. Another question we have for Rodney, what impact do you think a new and more regulatory focused SEC will have on the SPACs, if at all?
What do I think the SEC is going to do about SPACs? It's hard for me to say. I think that the incoming administration is going to be focused on stimulating the economy and not burdening the economy, not burdening industries with excessive regulation. So given that, generally speaking, special purpose vehicles like SPACs, they haven't been regulated out of existence. Some classes of special purpose vehicles are no longer with us, like portfolio credit derivatives, CDOs and CDO squares. The market for those things have pretty much fallen through the floor. But highly rated paper like mortgage-backed securities and CLOs. So mortgage-backed type paper is that's a securitization structure that is still very, very much active right now. SPACs, I don't think the SEC is going to do anything. Is not going to overly regulate SPACs any more than they are regulated now. It's just another issuance of another kind of paper. So and given that the incoming administration is committed, has stated that it's committed to stimulating the economy, I don't foresee any untoward regulatory weight on the SPAC market.
So, and SPAC, this is not their first rodeo. They were just called something else, it was blank check. And so I don't think that they are such a different, animal today. It'll depend on whether or not these get abused. I think that their resurgence has been after a trend of private equity firms sort of trading off among themselves for their own exits. And then as you get larger and larger concerns, it's harder to get the return that you need, harder to get, the leverage ratio that's not correct. And so now the public markets are the most viable exits, and then, allow some structuring for your next strategics. You know, years ago, and more than I would even like to admit, having been in practice at this point, we definitely did a lot of stock transactions. And so with a robust stock market, you've got a little bit of a piggy bank that you can utilize. And from that standpoint, I think, you know, the SPAC engine, as long again as it's not abused, as we saw a little bit of people sort of going public on air in 2001 or just before 2001, that if, you know, people are actually doing the due diligence that you talked about, Rodney, I think that, you know, we could have a robust opportunity for the continuation of SPACs. And quite frankly, you know, as a practitioner, I'd like to see that because I like to see the solid financials and the solid operating history on companies, you know, for our clients. So, question, want to move to sector a little bit. Clark, you know, we have been just waiting on the distressed asset sales to materialize, and we haven't seen a whole lot of in that space. You know, given that people felt that COVID and everybody learning to be digital will spell the death for real estate, do you think that the real estate market will see some of the distressed sales first, or do you think that we're looking in other sectors for that, like say the hospitality aspect of real estate?
That's a great question. And we are definitely seeing 2020 not being what everybody was pontificating about in March, as far as there's going to be rampant distress, there's going to be a lot of trades. There was a few, March, April, May, and the government stimulus, whether you count $2 or $3 trillion, it was an inordinately large amount of number, however you count it. And really that shored up the CMBS, the CLO, and all kind of securitization, with the government coming in and buying paper and then flooding the repo market with plenty of money, because liquidity is usually the problems in situations like this. Also, the little known fact is the Fed's come in and basically turned off the market rules for banks. So banks have been able to basically have their head in the sand on valuations and performance of their loan book. Once we start moving back gap rules, you will start seeing banks having to address non-performing and sub-performing loans, either selling them or starting foreclosure. You know, also state by state, there was prohibitions to enforcing loans. And so if you can't actually foreclose, you can't remedy a bad situation, it doesn't cause distress. But you can't continue to rob Peter and to pay Paul. At some point, we have to unwind that, and hopefully that is after a vaccine has been a little bit more available.
Yeah.
So 2021, Q2 and beyond, I believe there will be a lot of opportunities.
Do you think that people will take the opportunity also, you know, you and I have done a lot of talking about how do you have an end-to-end solution? If we've got these, you know, rent moratoriums that are about to, or you know, eviction moratoriums that are about to expire, will they be extended? Then what does that do for landlords, particularly landlords in the multifamily environment, who have to be able to perform on their loans? And then what does that do for the banks that have to make sure that they have performing loans in their portfolio? And these may be the same banks that participated in low margin PPP. So do you think there's an opportunity to really look at a re-amortization strategy in order to have an end-to-end solution, so that we don't have our consumer base, you know, sort of out on the street? And I know you differ on whether or not they'll get there, but let's say they're out on the street and
So
deal with that. So I'll let you respond.
I think you've hit the nail on the head, Jill. There is a problem there. It's just like life. There's usually 2 or 3 ways to solve it, and I'm not sure which one is going to be the right way. Usually it's going to be a blend of a few different ideas. So government, private sector, regulators need to get together, think through what is that solution. I am a believer that lenders in the capital markets are efficient, and you know, a lender, a bank, is not going to go through and foreclose on every single one of their individual, whether it's business or consumer loans. They are incentivized to try to work through situations. But we do need, as the lending population, we do need to have the flexibility and freedom to be able to enforce when necessary. Because I'll tell you, as a lender, especially in the Northeast and even West Coast, there's rampant misuse of those rules. People that are very capable of paying, large companies just saying, why should I pay? You can't do anything about it.
Well, and that ends up being, market as well in some ways. Everyone looks for how can they extend their cash cycles, from people wanting to pay their vendors on a slower pace, meaning that you're now making your, suppliers your financiers. So absolutely, there are issues with that. And usually it's the people who are strongest participants in the marketplace who know how to manipulate cash cycles the best. So.
Unfortunately, that is very true, and the solution is a long chain of dominoes. So you push one, and it starts to fall. It usually affects 5, 10 steps down the road. So it's very complicated, and that's why I'm a believer that it's going to take both private and public market working together.
Excellent. So we're starting to see everybody's faces again, which means we are getting ready to open up for more questions. I don't know if Brittany can let me know questions if people would like to ask some of those, and then I think we'll be moving into our networking period. So what I'm going to do while people are thinking about that and figuring out how they want to unmute themselves, we had a question here talking about hospital systems. That many hospital systems are launching interconnection between their private and public clinical settings. There's empirical evidence that supports the thesis that this sort of streamlining or efficiency has boosted investments by putting small providers together with larger providers, many of whom may have developed the technology itself. So the healthcare industry appears to be a little bit ahead of the curve regarding and investing in niche opportunities, and particularly the benefactors of large state and federal contracts. We see when we touched on kind of the public-private partnership aspect that's happening from the micro level of people getting a stimulus check in their mailbox to a broader level of actual sector funding. Do we see any particularized opportunities to use that partnership and to use the public financing piece in ways that could help us move forward in 2021?
Well, I certainly hope so. I believe I believe that infrastructure, could finally become a national priority. I think the question really is how comprehensive and how ambitious it will be. And I think we need to watch for that. I think the role of private companies, though, is substantial. And I would expect people to want to see and feel, fairly tangible results from the investment opportunities and from the projects that are actually, strategically developed and implemented. But I also expect that the financial markets will respond quite favorably to, new projects, and private funding is necessary for these infrastructure projects. But I think your example hits the nail on the head. There's got to be creativity and variation for project size. Some projects are, transformative and large scale, whereas others are, more micro projects, even micro within industry projects. And so I think, again, it's going to be important that the federal government take the lead on this. But I think that, as has been mentioned, it's got to be some combination of private and public partnerships.
Yeah, I'm hoping that, sort of we, the electorate and the taxpayers, have some appetite for that, and for that funding to really be transformative. My concern is that we do things on a smaller level that sort of burn capital and don't really make a real systemic difference. And I think we have some real opportunities, to do that, to bolster our economic resilience. We have got to come back in so many sectors, and this is a real opportunity to do that. What my own editorial is, I'm not seeing strategic use of these funds at the federal level. I have said this many times. It seems like they're dumping out coins like an old coin purse, instead of really strategically funding things that will, create a flywheel for the economy. So I'm hopeful, Washington, if you're listening, I'm hopeful that we can get some good cooperation to be strategic around what we have the opportunity to do, globally.
Yeah, I think prioritization is the key, and the prioritization function is definitely emanates from who's going to take the lead. So
Definitely. I would like to take this opportunity to thank our panelists. Life in Zoom is taxing for everyone, and I really appreciate the level of preparedness that they've brought to this, the data that they've shared, and I hope that it's been enriching to all of you as you're planning for your 2021 in deal making, that you've been able to have a window into the actual data that should be driving some of our decision making for the coming year. Thanks so much. Back to you, Brittany.
Jill, thank you so much for moderating the panel. And thank you to all of our panelists. It was such a great, informative session. And we did record this program, and it will be available for viewing soon. We hope you will all stay on for our networking portion.